Eric Chaney, you are chief economist of AXA Group. Development of the Eurozone economy depends a lot from the decision of the ECB, especially from Mario Draghi. What would you do if you were Mario Draghi?
Well, first of all, I have a lot of admiration for Mario Draghi. I think he's a fantastic president of the ECB, able to take big decisions and to gather political support for these decisions. But from a pure monetary policy stance, I think the ECB should have started earlier to expand its balance sheet. The balance sheet was shrinking, that was not good, that was in favor of deflation, not in favor of raising inflation. So I think the ECB should accelerate its purchase program of assets, whether they are private assets or public assets. What matters is really the size of the balance sheet in 6 months' time. I hope that the size of the balance sheet will be where the ECB would like it to be, because that would help to depreciate the currency, and that would also convince investors that they have to take more risks in their own investments, which would be good for the economy. I think the Eurozone is suffering from some sort of risk aversion, which is very bad for the economy itself.
The US Fed is expected to rise interest rates in summer 2015. What would be the impact on financial markets?
Yeah, well, this is a kind of consensus forecast. The financial markets will react not only to the date of the first rate hike, but also to the announced speed of tightening, and also to the link between the balance sheet policy going forward and the interest rate policy. If the financial markets have the sense that the Fed is lagging behind and is forced to go fast, then that could prove very, very bad for the bond market. We could see long-term interest rates rising very fast in the US with a ripple effect on other markets. This is not the most likely. The most likely is that the Fed will be extremely cautious in its policy, will raise rates at a very slow pace and will keep its balance sheet unchanged. So that will limit the damages, but at the same time, that will make things maybe more difficult 5 years from now.
And what about the emerging markets?
Emerging markets are highly sensitive to the monetary policy cycle in the US. So emerging markets are likely to be tested by the first rate hike. The good news is that we had a test in real time when Bernanke announced that the Fed was going to slow its purchases. There were capital outflows, but the reaction from emerging markets was quite good. They have increased interest rates and they have proved resilient. So I think they will prove against resilient, but we have to accept that there is a question mark about the capital outflows that could be triggered by the first rate hike.